All right, well, what about the financials? Who is next? Isn't that the question that investors are asking now? Robert Maltbie is Managing Director at Singular Research, and he joins us now. Earlier, putting out a report saying sell Goldman Sachs, and looks like that may have proven to be the right call, at least with regards to the financials, although this week we saw some come back, Robert. First off, Goldman Sachs, and we always ask, we've been asking, who's the next one? Does there have to be a next one? Will there be?
Unfortunately, we believe there will be one more, but not Goldman Sachs. But we think so. Based on the numbers, based on the balance sheets, it looks like WAMU is as concentrated as Bear Stearns and Countrywide were to high-risk loans and subprime and Alt-A.
And you're worried about non-performing loans, their exposure to arms, hybrid arms, et cetera. But, Robert, the stock has already been hit hard, down 70+% this year. Do you think the worst is already in it?
Well, probably not. It looks like there's further deterioration ahead. If you look at their book of business, they have over half of that exposed to negative arms, subprime, and home equity loans, combined with the fact that they're under-reserved right now, slightly, and more than likely they'll have to make more contributions to loan loss reserves. And what differentiates WAMU from, say, a Countrywide is the fact they do have a banking arm and do have a balance sheet where they can move and not mark-to-market loans. They can move them to their balance sheet. So it buys them a little time, but the numbers say there's trouble ahead, especially on the balance sheet.
I'm looking at some of your data from your note out there. About $13 billion in ARMs going to reset this year and next, $14 billion in 2010. So it looks like it could get worse on the reset side than better in the short term.
It does look like a lot of pressure, and combined with the fact they've got $24 billion last quarter in equity, the problem area loans are a factor of 2.5, 3 times that net equity. So if you do some mathematics and do it conservatively and price some of these things to the ABX, you can see that there's some potential damage here.
Yeah, and that's the issue, right? But can we price to the ABX index?
Well, WAMU would argue that you can't, but
that's right. That's their argument. They say, well, listen, it's traders, it's artificial, and in their defense, I mean, a lot of people out there say, the ABX, we can't trust it.
Well, reality will rear its head here soon, because at some point they'll have to take impairment when the loans become non-performers. That might be 90 days, it might be 180 days, but at some point, even when they're on the balance sheet, they do surface up.
All right, let's talk about Goldman Sachs, your other call. Now, Goldman was at $240 late last year, now $180. Hasn't taken the hit, as bad as that is, hasn't taken the percentage hit as some of its bigger competitors. The numbers that came out the other day, the market actually liked them, although reading your note on Goldman Sachs, you're saying, yeah, you know what, they're beating widely reduced expectations, right?
That's exactly correct, Brian. Instead of maybe a heart attack, it's a mild stroke. Very tough to make money in the finance business, particularly in investment finance and underwriting. Very tough to find things. Their main issue to us seems to be the large amount of money they have in level 3 assets, which are pretty much subjected to interpretation as to what they're worth. And this will flush out in their upcoming Qs, showing what's behind some of these numbers. A high percentage of their net income has been derived from level 3, showing perhaps questionable quality of those earnings. Also, FASB 157, which comes into play here this year, will put increasing pressure to mark those assets to the market. So they're trading at a premium of about 100% the book, and the rest of the world's at book. I know they're Goldman, but that's quite a spread.
And also, I'll tell you what, I know we got 9 months to go until 2009, but I've been reading up and learning about the Basel II Accords and the capital ratios that are going to be required here in America. We're going to have to learn about these level 3 assets across all banks' balance sheets this year, aren't we? Because they're going to have to change their capital ratios.
It's a comeuppance. There'll be a lot of pushback and fight against it. In fact, you're hearing that already. We'll see what comes, if there's a compromise or what drives out.